this is Tina Elmer with Prudential Fox Promotion. Welcome home, Philly TV. Today we're going to speak with Brian Domergue of McGovern and Associates. He's an accountant in the area, and he's going to give us some tips on accounting and with the home buying and selling purchases today. Hey, Brian.
Hi, how you doing today, Tina?
So Brian is my accountant personally. He's also a good friend of mine, and I know that he knows his stuff. You're an expert, and I know that I would not make it without you, as you know. But tell us, when someone is doing a purchase, purchasing a home, there's some stuff on that sheet that I always send out my clients, their HUD, which is their settlement statement after the transaction. Tell us what's deductible when you purchase a home.
One thing that people really don't quite understand is not every amount of money that you spend on a home is deductible. And the big things that you have to make sure that you count on the HUD 1 sheet would be that the real estate taxes, the points paid on the purchase, and also any mortgage interest that's already accrued from the mortgage company. And those are the only things that are really deductible when purchasing your primary residence.
Okay, so those things. And then when you own the home, you can take, so that's why we always say if you're making a certain amount of money, buying a home is a good thing to do because you can deduct that mortgage insurance.
Correct. You can deduct mortgage insurance. You can deduct the real estate taxes and the interest. And then if you're ever refining a house, you can still deduct the points paid on that over the term of the loan.
Okay, cool. Now what about when people are selling a home? Is there anything that's deductible on that side? I think that's something that I always wondered. I mean, besides your normal real estate taxes, insurance, is there anything else, like commissions or anything that's like...
When you're selling your home, you can deduct and take in any cost basis and against any profit that you made. Okay. However, you know, the IRS does allow you for each individual, $250,000 of a gain on the sale of your primary residence be exempt from taxes, as long as you live there for 2 years. Okay. If you live there for less than 2 years, then you have to have circumstances such as a change of job or a health concern.
Oh, and then
you would still qualify and not penalize you. So, if you're married filing jointly, you're still able to conduct about a $500,000 gain on the sale of your home without paying any taxes on it.
That's cool. It's good to know. I didn't know that if you moved that that was something that was like deductible still without getting penalized.
The only thing that the IRS says though is that since you are taking a gain tax free, you are not allowed to deduct any sale of a loss of your residence. So you don't get. So if you lose money in your personal residence, you do not get to deduct that on your tax return.
So it's like, I know you were telling me this story. Like if you, in today's unfortunate marketplace, if you take a $20,000 loss, have to come with 20 grand to the table, you can't write that off.
No, you cannot.
Oh, that stinks.
Yeah, that's where the IRS gets you. They say if you gain the money, we won't tax you as long as you're your primary residence, but we're not going to let you take a loss on it either.
So really, the main tip you have for homeowners, I mean, those are really the big things. The mortgage insurance, the real estate taxes. Okay. So if people have any questions or, obviously I personally... accounting is not my thing, so I always see you as the expert. But where can people find you?
They can always go to our website at www.cpaphilly.com and contact us via email or phone number, which is 215-483-5555.
Perfect. Well, Brian, thank you so much for your tips. Definitely helpful. I appreciate it. You can always find more at welcomehomephilly.tv as well. Thanks, Brian.
Take care.